Hello and assalamu alaikum everyone. I am Kashif Kamran and welcome to the session 1 of the March 2025 Webinars to Success for Advanced Audit and Assurance. And today I will be investigating the September-December 21 paper, and I will be looking into the question number 1, part C specifically. Now, the question number 1, part C, even though that's nothing unusual, but I just want to put some more emphasis to a question like such, which comes in the exam paper. And you must have seen a question like such a couple of times in the prior paper. If you have practiced the recent 5 to 6 exams, you must have seen a question like such coming very oftenly. Now, I just want to have a word with you on a question like such, just to make you very familiar that you're not doing any mistake when a question like such pops in into your exam paper. Now, in the question number 1 of the September-December 24 paper, there was nothing unusual. I'll just be showing you a glimpse of that on the practice platform shortly. But if you look at this question number 1C, particularly in front of your screen, it says the group was formed during the year with the parent company, Hart, acquiring its first subsidiary. So for the first time, Hart Company has acquired a subsidiary. So by virtue of that, they have become a group for the first time. Therefore, this is the first year that the group will prepare the consolidated financial statement. Now, anything which is done for the first time, there are some underlying issues. So this is the first year that the group will prepare the consolidated financial statement. Now, honestly, tell me, when the group is preparing the financial statements for the first time, the group financial statements for the first time, are they aware of it? Do they have adequate knowledge about how to prepare a group financial statements? Because they've never done so in the prior years. This is the first time they acquired a subsidiary, and by virtue of that acquisition, they will be preparing the consolidated financial statement. They will be preparing the group financial statement. So is the group well aware of this? Or can this result into some sort of misstatements because of lack of knowledge? Yes, definitely, right? Because they are doing it for the first time. So lack of knowledge about the accounting standards, which goes with the consolidated financial statement, they might not be very good onto that. And then that means that the consolidated financial statements are at risk of misstatements. So anything being done for the first time, and you see this in exam paper, be very watchful. Then you go further and it says using exhibit 4. So examiner is saying that you only need to use the exhibit 4, not any other exhibit. Justify why the acquisition of the Morton company and the goodwill arising on the acquisition are significant risk of material misstatement. Now, when you're reading in a hurry in exam, you might think that the examining team is only asking that justify why goodwill is a significant risk. Examining team is asking for two things here. Justify why, number one, acquisition, and number two, the goodwill arising on the acquisition is a significant risk. So if you just focus on goodwill and you don't focus on acquisition, you're getting half the marks. And you just focus on acquisition and you don't focus on goodwill, still you're getting half the marks. So at times you need to read very carefully because the examining team will be using a comma, or look at this word over here, and. At times we ignore this word and we just read it in a hurry. So wherever there is an and, please focus on that very carefully. So we are to justify why acquisition and goodwill are significant risks. This why is important because a lot of time the students will tell everything, but they will not be telling why. Why means the reasons. Why means the basis. Why means the perspective. Now, my perspective will differ with your perspective, so there could be no one right answer. Now, I've seen so many student answers for September, December 24, and each of them was giving a different perspective as to why acquisition is significant, or as to why goodwill is significant. And in that case out, uh, in that case out, uh, most of the student, even though had a different perspective, but were very right. So please ensure on that, right? Then can you look at this word and again? Second time this word and is coming in. Design the procedures. So you need to design the procedures on the goodwill, on the goodwill arising on the acquisition. So you need to make procedures on the goodwill. Now, honestly, tell me, you must have seen questions on goodwill in the past papers if you have done like 7 to 8 or 8 to 10 past papers. Goodwill has not come for the first time. You must have seen that even in the past papers, examining team has given you a proper schedule of the goodwill, proper breakup of the goodwill, and you're very familiar with this subject matter goodwill because this is one of the popular subject matter with the AAA examiner. Now look at the note number. Student, do miss to read the note number. The note number says you should consider all components of the management goodwill calculation in your justification and procedures. So you need to see the management calculation of goodwill, every component of management calculation. And you need to justify why goodwill is a significant risk. And you need to use every component of the goodwill calculation to make your procedures. Is that clear to all of you? So when you look at the calculation of goodwill in the exhibit number 4, you will use every component of the calculation in your justification why goodwill is a significant risk. And in your procedures, you will use every component of the calculation to make your procedure. That note number is important. Now, you know there are communication skill marks in question number 1, and one of the significant element of gaining the communication skill marks is adherence to what is being asked. So exhibit 4, the note number, look at the word and. These are all important things when you need to fetch full marks on communication skill. Do what is asked and do in the manner it has been asked. Time management. This is a 12 marks question, so you have 1.95 minutes per mark in the AAA paper. So in a total time of 23.5 minutes, you will be finishing off this question, including the reading time of 6 minutes. And I always tell my student, you need to stop and move on. So in 23.5 minutes, wherever you reach, probably you might finish 70% of this answer, or you might finish 75% of this answer. Stop. Don't complete the answer. Stop when the time is up and move on. This is the strategy I have been emphasizing since last many exam settings now. But the problem is that the student will never stop. They will keep writing even when 23.5 minutes are over. So you are killing the opportunities you have in the other questions. Never kill the opportunities. Maximize the opportunities if you want to pass the AAA paper. Okay, now we have 12 marks, so that means 6 marks will be taken for justify why, and 6 marks will be taken for the procedures, right? And you know the marking scheme is 1 mark. For every justification you write why acquisition is significant or why goodwill is significant, for every justification, you will get 1 mark per justification. And same goes with procedures, 1 mark per procedure. Is everyone clear with the holistic scan of this question number 1, part C? Any questions you would like to ask about this holistic scan before we go into and start looking at what exactly needs to be done? Okay, thank you so much. If you're all clear, let's look into the practice platform then. I hope you can see the practice platform in front of your screen. I might need to put my camera off at a certain time just to ensure that you can focus on the screen and you can just keep your focus on the exam question. Now, when you look at this September-December 24 exam paper on your screen on the ACCA practice platform, you know that the partner email sets the tone, and the partner email exactly tells us what to do. So this is important. Now, when you read through this partner email, the partner email is telling us the most important thing here, that When determining materiality, please use revenue as your basis. So you need to use revenue as the basis of determining the materiality. Mostly, we get profit before tax, but this time we had revenue. That's not a problem. You know the three thresholds, right? On which three factors, sorry, on which materiality is determined: total assets, profit before tax, and revenue. So this time you have to use revenue. Then examining team is saying that yes, Edmund, you have 6 marks to justify why acquisition and goodwill is a significant risk. So you have 6 marks for the part one, in which you will be justifying the acquisition as well as the goodwill, right? Both the things will be justified. Okay, now in the first part, you need to prepare the briefing notes. You know, that's very natural that the question number one is answered in the briefing note format. You're familiar with the format of question number one, right? You know exactly how the email is structured. You know how the partner gives you an instruction about materiality. Then you know that the partner will be telling you you have to prepare a briefing note. And then you go down saying using all exhibits. Look at this, how important this is. Using all exhibits, evaluate the significant risk, business risk, sorry, for 8 marks. Now you're very sure 8 marks means divided by 2 because that's the marking scheme for business risk. So you have to write 4 business risk, the significant one in the exam paper. Now, the simple definition of significant is that if you find a business risk for which the management has already taken a mitigation, never write a business risk for which the management has already taken a mitigation. That will not be significant. Except for that, all business risk given in the scenario will be significant. Be clear about that, right? Now, using all exhibit, how many risks we need to find? 4. So how many exhibits we have? The partner email is the partner email is just the requirements, right? You will not find a risk from the partner email. So how many exhibits you will have after the partner email to find the risk? 3. So from every of the 3 exhibits, minimum how many risks you need to find to meet the requirement? Use all exhibits. 1. I should find 1 from the background information, 1 from the meeting notes, 1 from the goodwill calculation, and from one of them I need to find 2. So from any one of them you can find 2, and from the rest you can find 1 and 1, but you have to use all exhibit. If you don't use all the exhibits, no problem, you will still get your technical marks. You will still get 8 marks, but you will lose communication skill mark, which is a professional mark. But yes, if a student use all exhibit, he or she is not just getting 8 out of 8, the technical marks. He or she will also get 1 communication skill mark because you adhere to the instruction. Is that clear to all of you? So if you want to lose 1 mark, then you can find all the 4 risks from any one exhibit or any 2 exhibits. But if you want to take 8 marks plus 1 communication skill mark, then you have to go down digging risk from each of the exhibits given. So please ensure you do that. Next, and 4 business risk is not a big number, right? Using exhibit 1, 2, 3. Now the examining team is saying that you have to use only the exhibit 1, which is the partner email, exhibit 2, which is the background information, and exhibit 3, which is the meeting notes, not the fourth, in evaluating and prioritizing the significant risk of material misstatement. So now you need to identify the significant risk of material misstatement using exhibit 1, 2, and 3. You will not find a significant risk of material misstatement from exhibit number 4, and you know the reason. Because exhibit number 4 has been specifically used in the requirement C, and that's the note number. You will need to determine and apply an appropriate materiality threshold in the briefing note. And you know that appropriate materiality threshold you need to apply in the briefing note will be based upon revenue. Note, look at this note number, which the student mostly ignore in exam. You are not required to consider risk of material misstatement in relation to the acquisition uh, of Morton Company at this point, as this will be dealt in part C below. So you are not writing any risk relating to acquisition or to the goodwill arising from acquisition, because that is in exhibit number 4 and that relates to part number C. Any student who mistakenly write about acquisition or goodwill in part B, you will not be rewarded any technical marks and you will be losing your professional marks as well because you're not adhering to instructions. So, is everyone clear what to do for part A using all exhibits? What to do in part B using exhibit 1, 2, and 3? Which materiality factor you have to use? And please read the notes given under the requirements because at times students don't read the note numbers very well. Then you go down to the C requirement. We have already brushed over the C requirement from the PowerPoint presentation, so I'm not reading it again. And then you come to the D requirement. Using exhibit 3. So which exhibit we have to use for the D requirement? Only the exhibit number 3, not any other exhibit. So using the exhibit number 3, which is basically the meeting notes, discuss Broadway and company responsibility in relation to the group non-compliance with laws and regulations. So what is the audit firm responsibility in relation to a non-compliance with laws and regulation? That's a knowledge area in relation to the refurbishment of the historical building without permission. So there must be an issue. There must be an issue in the meeting note, in the meeting notes, which you have to read, and then you need to write what is the auditor responsibility for non-compliance in relation to laws and regulation, particularly to the refurbishment of the building without permission. You have 8 marks, so you need to have 8 points for that because everything is worth 1 mark. Okay, that finishes off the structure. This is nothing unusual. We have seen question number 1 in the same way. Business risk, risk of material misstatement, something around goodwill, and then laws and regulations. And you know how question number 1 is structured. At times you find ethical issues. At times you even find practice management issues coming into the question number 1. So you're fully versed with how question 1 comes in exam paper. Now, just to give you an idea, we are looking at the part C primarily, right? We're not looking at any other part. We just close this partner email. Okay, you go back to the briefing note. Just to save my time, I've already structured the briefing note to, from, subject, date. You know how to do that because I've guided this so many times in my previous webinars as well. Then you give an introduction and you write an introduction of like 2 to 3 sentences where you tell what you need to do. You all know how to write an introduction, right? The introduction is basically the purpose of writing the briefing note. Now, what is the purpose? Is to evaluate the significant risk of material misstatement, justifying why goodwill and acquisition is a significant risk, procedures on goodwill, and responsibility for non-compliance with laws and regulations. So this is the 5 things which should come in the introduction. These are the 5 things for which we are writing this briefing note. Can all of you write the introduction? Do you know how to write it from my previous webinars? Will you be able to fit in the introduction, all of you? If you have watched my previous webinars, okay, great. So please ensure you write the introduction. Then the first part after introduction is business risk, right? Now, how many business risk you need to write here? 4, because you have 8 marks and you will be using all exhibits. You write in the business risk, right? So that's how you filled it up. Then you go to the second part. After finishing the business risk, you will write significant risk of material misstatements. the next B part. Now, under the significant risk of material misstatement, you will write materiality because you need materiality to evaluate the significant risk of material misstatement. Only a risk which is material will be a significant risk of material misstatement. So you need to determine the materiality under the heading B. Now see my answer, materiality determination. I went to the meeting notes probably. Yes, in the meeting notes, can you see the revenue number given? 446 million. Can you all see the revenue number on your screen? $446 million. That's the revenue number for the 30th September 20X5. So I determine the materiality. Materiality is determined on the basis of the revenue as deemed fit by the engagement partner. The range of materiality on revenue is 0.5% to 1%. I'm first telling the range, that this is the range. Heart Group revenue for September 20X5 is projected to be 446 million. Now I'm telling that the revenue is 446 million for 20X5. Materiality would be at 0.5%. Materiality would be $2.23 million at 0.5%, and and 4.46 million at 1%. Now you found the materiality, that 0.51. Now the most important thing you need to do after determining the materiality is to justify which which amount will you use and why. Considering Heart Group is our existing client, because nowhere it was mentioned in the scenario that it's a new client. So when the scenario is silent means it's our existing client. However, with the present additional risk around recent acquisition and goodwill, for the first time, Heart will become a group. And as an auditor, I need to be responsible not just for the individual financial statement, I will be responsible for the consolidated financial statement. So there are additional responsibility for me as an auditor. So considering the recent acquisition and goodwill, even though it's our existing client, it is concluded to keep the materiality level at the lowest threshold of 2.23 million, which is 0.5%. So we had two levels, 2.23, 4.46. I could have used something in the middle. You can even use something in the middle like 0.6%, like 0.7%. That is also possible. But I just used the lowest one, considering the additional risk that the company is becoming the group for the first time. And because the company is becoming the group for the first time, that is such a significant event that I will be using the lowest threshold for the current year audit, which is 2.23 million. The justification is important. It's not just to tell the range 0.5 to 1, that's 1 mark. Calculate the materiality at 0.5 and 1, that's 2 marks. Then justify which will you be using and why, that's 3 marks. So you have 3 technical marks, right? Everyone knows that, right? 3 technical marks for materiality. So you find the range, 1 mark. You tell that this is 2.23 million and 4.46 million, you get the second mark. And then you tell which level are you using and why. And I've given my why, right? Look at my why. Justification. At times, the student do the wrong calculation of materiality. They don't know the millions and thousands. They do mistakes in millions and thousands. At times, the student uh, uh, do take the right percentage, but they calculate the wrong answer. Please don't do that. Is everyone clear with the materiality determination and the 3 technical marks around that? Even though I've guided this multiple times in my previous webinar, but just to ensure that you're all familiar with how to go about it. Then after the materiality determination, You will be starting to write the ROM. How many ROMs will you be writing? How many marks we had for ROM? We had how many marks for ROM? 12. Okay, so 12 marks for ROM, right? So how many ROMs will you be writing? 12 minus 3 is equal to 9. 9 divided by 3 is equal to significant, 3 significant ROM. So how many significant ROMs you need to find from the scenario? You know every significant ROM is worth 3 marks. Zoha, why 4? Isn't it 9 divided by 3 is equal to 3? Right? So we need to find 3 significant ROMs. Unless and until you find a ROM which is of 2 marks and which does not relate to an accounting treatment, then only you can go to 4. Yes, then only you can go to 4, Zoha. But apart from that, if you go with a straight equation, how many ROMs we need if you're working on around the accounting treatments? 3, right? So that's not a very long answer, right? So you write the 3 ROMs here, and after that, the 3 ROMs you wrote, 1, 2, 3, you will give a conclusion. Which of the 2 above are to be prioritized and why? So the 3 ROM you wrote above, which 2 are more important and why? Or which 2 are need to be prioritized and why? Because the question says you need to evaluate and prioritize the significant risk. So in the conclusion, you will be telling that which of them are to be prioritized. So you might say 1 and 2, you might say 1 and 3. So you will write 3 ROMs in any order. In any order, you will write the 3 ROMs. But in the conclusion, you will tell which 2 of them are more important and which 2 of them are to be prioritized and why. This why is important. A lot of times the student miss this why. Is everyone clear? I hope I've given this justification even in my December 24 webinar to write the ROMs and then to give conclusion which 2 are important and why if you have watched the December 24 webinar, right? So see the format in which we are going in. Then comes the C requirement. Now that's what we are focusing on a bit. In the C requirement, we have acquisition and goodwill as a significant risk. And then we need to write the procedures on goodwill, right? So we know the materiality threshold, 2.23 million. And you have to justify why acquisition and goodwill is a significant ROM. Okay, let's open the exhibit number 4, which is so special. Okay, just let's see what's happening in exhibit 4. Okay, I'll be reading with you and I'll be asking you, and we keep accumulating our points. Number 1, on 1st October 20x4, the parent company acquired 100% shareholding in Morton Company. 100% shareholding, right? So not thinking about the non-controlling interest, because a lot of times the student thinks about something illogical. A small theater company which owns and operates 3 established theaters. This is the first time Heart Company has purchased another company, and the transaction was completed very quickly. Look at this. Is this the first point where I need to justify why acquisition is a significant risk? This is the first time Heart Company has ever purchased a company, and that too very quickly. This transaction was completed very quickly. Why this transaction was completed very quickly? The reason is given in the next line. No final due diligence report in respect of Morton Company's financial and operational viability was prepared. Is that strange? Normally, when we are acquiring a company, we do ensure that a due diligence is performed. And Heart Company was doing it for the first time. So when they were doing it for the first time, Was there a need of a proper due diligence? Was there a need that the management should have hired an auditor to perform a due diligence? In that way, you could have got a better fair value of the net assets. But you didn't bothered about conducting a due diligence, and this transaction was completed very quickly. Now tell me, is there a risk of misstatement in all this calculation shown below? Is this calculation at risk? Absolutely. Now, the first thing is here. I'm copying this line in yellow, Control C, and I'm taking this line in yellow on my word processor, and I'm just writing it here. Control V. Now we go back to the exhibit number 4, and it says Morton and Company will be audited by Broadway. So next year, because we are the auditor, and Hart Company has already acquired Morton as a subsidiary. So we, as the auditor, will be auditing Broadway as an additional responsibility. The goodwill calculation prepared by the management at acquisition is shown below. Who prepared the goodwill calculation? Prepared by the management. Control C. That's another risk. We know there could be underlying risk of management bias because management prepared the calculation. They're doing it for the first time. Even if the management is doing it for 10th time, 11th time, whatever the management do has a risk of management bias. And over here, not just the risk of management bias, we have an additional risk that this all is being done for the first time. Agree or disagree? I think the most important risk here is that it's been done for the first time. Lack of experience, lack of knowledge, lack of competence, that is all increasing the risk. That is all increasing the risk, right? That the numbers below could be misstated. So copy paste, Control C, Control V, number 2 point. Goodwill calculation prepared by management. See, I got 2 points already from my scenario, which I will be developing into my answer. Now you go down into the goodwill calculation. Cash consideration paid on the October 20X4, 22 million. Okay, fine. You paid a cash consideration. Once I'm making the procedures, I will make the procedure from bank statement and I will verify the bank statement for the consideration paid. Or I can even review the purchase agreement at the time of acquisition to confirm that the cash consideration was $22 million. So I can make a procedure on cash consideration because that's not something subjective. Then comes deferred consideration. Now, deferred consideration is $10 million payable on 30th of September 20x6. So you have to pay this after 2 years. And you have taken the fair value of $10 million, which is 8.3 million. Sorry, you have taken the present value of 10 million, which is 8.3 million. We know, yes, this contingent consideration or deferred considerations are part of goodwill calculation. That's not wrong as per IFRS 3. But look at the note number 1. The note number 1 says that the deferred consideration is contingent on the Morton Theaters achieving revenue targets by 30th of September 20x6. So you will be paying this on 30th of September 20x6, depending the conditions or the contingent consideration is met. The amount become payable on the same day. You will pay the amount on the same day. That's 30th of September 20x6. That's why you've taken the present value of it at 8.3 million. Management has assumed the full amount will be payable and has discounted this amount at 10%. Now, management has assumed a full amount will be payable. That's an assumption, number 1. And number 2, they have used a discount rate of 10%. Auditor needs to check the authenticity of the discount rate. Auditor needs to confirm that the discount rate of 10% is appropriate. It could be 9%, it could be 8%, it could be 12%. Is there a risk that $8.3 million present value could be under or overstated? Is there a risk that the liability, because contingent consideration is your liability, right? Contingent consideration is your liability. And contingent consideration is part of your total consideration. So is there a risk that the liability and the total consideration could be under or overstated because of the inappropriate discount rate? Liability, liability and the total consideration are at the risk of under and overstatement. Is that clear to all of you? Right? So 8.3 million could be 9.3 million. 8.3 million could be 10 million. 8.3 million could be 5 million. So because of that, uh, the total consideration and the liability is at the risk of under and overstatement because management has used the discount rate of 10% and we need to confirm the authenticity of that. I hope you're clear on that. So the number next point is the deferred consideration and the discount rate used at 10%. So control C, and we take it to the briefing note. Control V, that's another point. We go back to the goodwill calculation. Okay, we got the total consideration finally. Then from the total consideration, we deducted the fair value of net assets. We know fair values are estimates, and that makes them risky. And the fair value of net assets is 15.5 million, which is very subjective. Let's see what have they done in the assessment of 15.5 million. Let's go to the note number 2. In the note number 2, it tells us fair value of the identifiable net assets includes an adjustment of 4 million, includes an adjustment. So it's included in it, right? Includes an adjustment of 4 million in relation to Morton customer database, which is not recognized on the statement of financial position of Morton. So this was not recognized on the statement of financial position of Morton, but you have included it in your net assets because you have purchased the company, right? So that's now a purchased customer database. This was estimated by management of Morton Company. So who has estimated the fair value of this customer database? Who has estimated the fair value of this customer database? Management of Morton, the company you are acquiring. So is there a risk of subjectivity? Is there a risk that this 4 million could be 5 million? This 4 million could be 2 million, right? So 4 million, is it self-material? How much was our materiality threshold? How much was our materiality threshold? 2.23 million. So is 4 million alone material? Yes. And is there a risk because the fair value of this customer database has been determined by the management? So there is a risk of under and overstatement with the fair value, which could directly understate or overstate the goodwill. So fair value would directly understate or overstate the goodwill because it's a component of a goodwill. Lastly, $4 million, control C, and we take it to a Word file, control V. Okay, next last point. No adjustment has been made in respect of Morton Company brand, which was internally generated as the director did not feel they could reliably estimate the value. Have they included in this fair value of net asset the Morton Company brand, which they thought was internally generated? I'm waiting for your perspective. Have they included the Morton Company brand, which was internally generated, in the fair value of net assets? Should they include it, Shaifa? Should they include it? Yes, because it's an internally generated brand. But are we purchasing the company? Are we purchasing the company? So will this internally generated brand be recognized on the financial statements of Hart Company as a purchased brand? So have we included the valuation of the internally generated brand in our fair value of net assets? So is fair value of net assets understated? Right? So what about the goodwill? Is goodwill like overstated? If the fair value of the fair value of the net assets is understated, so look at the bottom number 14.8. Is goodwill overstated? Right? So do you all agree that this internally generated brand on the Morton of Morton Company should had been recognized as an as part of the net assets because you're purchasing the company, right? So $4 million was included, but who did the estimation of $4 million? The management. And interestingly, the internally generated brand was excluded. So we get another point. Control C, and we get the next point. Control V on the word processor, and that ends the answer. And how much was the materiality in total? The materiality in total is 14 point, sorry, goodwill in total is $14.8 million. $14.8 million is the goodwill. So is goodwill material? It is. Now, how many marks we had? Justify why acquisition and goodwill arising on acquisition is material, is significant. How many marks we had for that? Anyone remember that? How many marks we had for justify why acquisition and goodwill is a significant risk of material misstatement? We had 6 marks for that, right? Now, see the points I have on my screen. Can you see these bullets I've copy pasted while I was reading? How many bullets can you see on my screen? Which I copy pasted while I was reading the scenario with you. 5. And one is the materiality. One is the materiality of the goodwill. Why goodwill is a significant risk? Because it's material. $14.8 million. So if I'm writing my 6 points, just let me show you how would you go about it. Acquisition and goodwill as a significant risk, right? I'll write under this. Acquisition and goodwill arising on acquisition of Morton Company uh, is a significant risk because of the following. Because of the following. Number one, the goodwill at acquisition of $14.8 million is material as it exceeds the materiality threshold set at the start of the briefing note, which is $2.23 million. Number one. So is that the first justification that why goodwill is a significant risk? Because it's material. Is that the first justification? All of you? Do I need to drag this justification, or the length I wrote for this justification is fine because I'm just telling this is material, full stop? Do I need to unnecessarily drag the statement? Not at all. So I'll just be getting my first 1 mark here. Then I go to the next paragraph and I'll say, this is the first time Hart Company has purchased another company, and the transaction was completed quickly, and no final due diligence report in respect of Morton Company financial and operational viability was prepared. Uh, the management of Hart is inexperienced, with is inexperienced with acquisitions, is inexperienced with acquisition, and because this transaction was completed quickly without any due diligence, there is a greater risk that the numbers used in goodwill calculation are at risk of material misstatements. Moreover, management is unaware of preparing management is unaware of preparing group financial statements, which they will be preparing for the first time, right? Moreover, the management is unaware of preparing the group financial statements, and once they are prepared for the first time, it will be prone to misstatements, like, for example, the intercompany balances, the intercompany balances between Hart and Morton, full stop. So the management of Hart is inexperienced with the acquisition, and because this transaction was completed without a due diligence, there are chances of significant misstatements in the goodwill calculation. And moreover, because the management will be preparing the group financial statements for the first time, they are inexperienced with preparing the group financial statements, and there could be risk of misstatements. For example, the intercompany balances, and the management will be unaware whether they should eliminate the intercompany balances or they should not eliminate the intercompany balances, and that becomes one example of a risk. Look at the point number two. That's the second justification why acquisition and goodwill is a significant risk. I got my another one mark. Then next, goodwill calculation prepared by the management. Goodwill calculation is prepared by management, and due to their lack of inexperience there are lots of elements in goodwill calculations where management has used estimates like fair values and contingent consideration and contingent consideration, which uh, increases risk of under and overstatement in goodwill calculation. From the point number two, you can remove this point, right? There's a greater risk due diligence. Okay, fine. Another one mark. Then deferred consideration of $10 million payable on 20th of September. Deferred consideration of $10 million payable on 30th of September 2026 is discounted to present value using the discount rate of 10% of $8 million. Using a discount rate of 10%, there is a risk about the authenticity of the discount rate used by management, which could under or overstate the liability, which is the contingent consideration, and it could under and overstate the total consideration total consideration paid or payable. It will over or understate the total consideration paid or payable, because there is a cash consideration and there is a contingent consideration. Full stop. Next, $4 million. Yes, Shaifa, we're just writing very generic, right? We are not taking any affirmative stance because it could go both ways. So we're just saying under or over. We're not keeping one direction open at the time, because there is a lot of subjectivity, right? That's the reason we're not taking any clear stance on under or over. Okay, the next point. $4 million in relation to Morton Company customer database, which is not recognized on the financial statement of Morton. This was estimated by management of Morton. $4 million in relation to customer database was estimated by management of Morton Company and is included in the fair value of net assets. There is a risk that the fair value estimates of management are inappropriate, which increases the risk of an under or overstatement in the fair value assessment, which directly affects, which leads to under or overstatement of goodwill. Because if the fair value of net assets understates or overstates, it will directly link down with the goodwill. The goodwill will become understate or overstate. Assessment will lead to the understatement or overstatement of goodwill. And lastly, no adjustment. You can write one more point here. The $4 million, uh, the $4 million in relation to customer database, to customer database included in the fair value component, included in the fair value of net asset, is itself material as it exceeds the materiality threshold of $2.23 million. So every justification you're writing, you're getting a minimum of 1 mark, because you're also scoring on your professional skill marks as well. And lastly, no adjustment has been made in respect of the Morton Company brand, which was internally generated, as the director did not feel they could reliably estimate the value. The directors should had recognized the internally generated brand on acquisition as part of fair value of net assets, because you're acquiring the company, right? This internally generated brand will become a purchased brand. The director should have recognized the internally generated brand on the acquisition as part of the fair value of the net assets, uh, and could have employed an expert to determine the fair value. They've not even conducted the due diligence. Had they conducted a due diligence, they could have got better fair value assessments of the customer database. They would have got a better fair value assessments of the internally generated brand, and they would have got a better assessment of the overall fair value of net assets. But they did so, and could have employed an expert to determine the fair value of internally generated brand. Uh, as this is not included in the current fair value of net assets, The goodwill is overstated. The goodwill is overstated. Now we are very sure, Shaifa, that the goodwill is overstated because you have not included the fair value of the internally generated brand in your fair value of net assets. Have you included that? Your goodwill balance would have come down. Now, currently, your goodwill balance is overstated, and that's basically the intent of the management. The management wants to overstate the goodwill, and you get one more mark here. Now, again, this is just a quick answer. You can refine it. You can sit down with this answer, add more value to it, add more refinement to it, because this has just been written in a hurry in this scenario of a webinar. But look at this structure in front of your screen. We have almost 6 bullets, and that means 6 marks. Is that clear to all of you? How to go about writing an answer on why something is significant? And we have seen a couple of questions on that, why inventory is significant or why goodwill is significant. We have got questions like such in recent past papers of AAA. Even, uh, you acquired even you acquired this company when? You acquired this company on the 1st of October 20x4. And what's the year end? The year end is 30th of September 20x5. So 1 year has gone. What about impairment review of goodwill? Should we perform an impairment review of goodwill? Is that an additional risk? Should we perform an impairment review of goodwill? Because it's been 1 year since the acquisition, right? What about the impairment review of goodwill? 1st October 20x4, now it's 30th of September 20x5. Should we review a goodwill for impairment? $14.8 million. And what if the management has not performed an impairment review? What if the management has not determined the recoverable amount of goodwill? But in that way out, could we say the goodwill could be overstated if no impairment review has been performed? And yes, if there are any indications of goodwill impairment given in the scenario, you can link them up as well. But is everyone clear that you can write an additional point on impairment as well if you don't want to write any of the 6 points above? You can skip 1 point and you can think about impairment as an additional point. Think about impairment of goodwill as an additional point, and skip any of the point above. Any of the point above. Is that clear? So this is just a note number I'm giving under my answer. Okay, then downside, you need to write procedures on goodwill. You will just go down making your procedures. We've already talked about so many of our procedures. First of all, uh, you can review the board minutes for the affirmative approval of this acquisition. You can understand management reasons in the board minutes, why they didn't prefer the due diligence to be carried out, and what was the haste, because this transaction was completed very quickly. So the board minutes would not just give you the approval of this transaction, they will also give you some underlying basis why the due diligence review was not carried out, right? Or you can even discuss with management the basis or the reasons why the due diligence review was not preferred, considering you were doing it for the very first time. Then you can have a cash consideration. Can you verify the cash consideration to the bank statement? Can you make a procedure on that, all of you? A procedure on, you must have seen my procedures on goodwill in the prior papers I've done. Deferred consideration. Can you uh, recalculate the deferred consideration? Can you recalculate the present value of the deferred consideration yourself to check the authenticity? Can you discuss with the management the discount rate used? Can you discuss with the management about the authenticity of the discount rate used? Okay. Can the auditor uh, determine the fair, can the auditor reassess the fair value? No, sorry. Can the auditor review the working of the management for the fair value of the net assets? Because you were not involved in the due diligence. So can you review the fair value of the net assets? Can you ask management why the internal generated brand is not included? Can you review the management impairment working? Can you review the management impairment working? Can you discuss with management the basis of the discount rate used? Can you check? Can you review the working of Morton Company with regards to the fair value of $4 million customer database? So can you go to the individual numbers and can you verify the individual numbers? Like 22 million can be verified to the bank statement and the purchase agreement. You can take the overall board minutes. 8.3 million can be recalculated. You can discuss about the discount rate. You can make two procedures on 8.3 million. 15.5 million, you can review the working. You can also review the working of 4 million, which is part of the 15.5 million, which is something estimated by Morton Company. You can even discuss with management that why internal generated brands have not been included. Yes, why management didn't use any expert, or why did management not perform any due diligence review? So I hope you can make the procedures because I've covered Goodwill before even in my classes, in my full classes. You must have seen a couple of questions around Goodwill with almost identical looking calculation on your screen. Have you seen questions on that in my classes with a similar looking schedule of Goodwill? All of you? So will you able to do it? The procedures? Yes, exactly, Shaifa, that's a good thought process. Shaifa is saying we can also review the future business plans to ensure revenue targets will be met because on those bases you need to pay the deferred consideration. So you can review the future business plan to ensure the realisticness of how the plans will be met. Okay, so you will finish off the procedures and then you will go down writing the answer for the last part, that is auditor responsibility for laws and regulations, and then you end your briefing note. No need to give a conclusion because you've already given a conclusion for uh, the part B. Which of the two are important or which of the two are to be prioritized and why? So you've already given a conclusion for the part B. For part A, business risk, you not need to give any conclusions for business risk, no conclusions for business risk. For part B, justify which of the two are more important, you give a conclusion. For part C, you are already justifying why each of the above are why each of them are significant risks. So no need to give a conclusion because you've already given your justifications here. And finally, you write about procedures and auditor responsibility for laws and regulation, and you wrap up your answer. I hope you all will do excellence on question number one. It's a very structured question. You know it's to be prepared in a briefing note format. You know there are A, B, C, D. You know the typical questions which comes in question number one. It's just about reading. It's just about controlling yourself. It's just about linking with the case study and just about extracting information from the case study, just as I do for the exhibit number four. Focus on the note numbers, focus on the instructions of the partner, and just go down blending the best of the answers for the question number one within the total time of 98 minutes you have for the question number one. And wherever the time ends, stop and move on. Don't rush to complete the question number one over the time. So 98 minutes, stop. Even you completed 80% of the question number one. Stop and move on. Okay, I hope you will largely benefit from this exercise around September, December 24, question number one. I hope you will fill it up and you can send the answers for review if you still want to. And we will be doing another session tomorrow and then day after tomorrow, where I will be looking at the question number two and then the question number three. Okay, all the best to all of you. study effectively, and I'll see you back with the session 2 and session 3. All the best. Take care. Goodbye and Allah Hafiz.